Hi, I'm Jamsi. I'm a finance professor and welcome to another video. So today we're going to start on a short topic, but something of equal importance with other finance topics. So it's important that before we actually begin an in-depth discussion of the different markets within the financial system, we have to first understand the fundamentals of that market, and that is achieved by understanding the role of the central bank and understanding how monetary policy impacts the economy. So, first off, let's differentiate the two. Monetary policy pertains to the activities done by the central banks that directly influence money and credit in the economy. So, monetary policy is focused in achieving the macroeconomic policy objectives such as full employment, price stability, and steady economic growth. So, monetary policy is under the purview of central banks. So it's the central banks that call the shots when it comes to the implementation of monetary policy. So when they implement a particular monetary policy, they would like to control the money and the credit that is circulating in the economy. So the goal of monetary policy is that you would like to achieve objectives such as full employment, price stability, and economic growth. Okay, but on the other hand, there's also fiscal policies. So both policies are related to financial matters. So fiscal policies, on the other hand, revolve around the government's decision on taxation and spending. So that's where you see the difference between the two. So monetary policy controls money and credit in circulation, meaning money and interest, and the loans that are currently in the market. However, the fiscal policies revolve around decision on how people are taxed and how the government is spending that particular fund, or how they're actually spending government funds. But what these two have in common with is that both monetary and fiscal policies are used to regulate economic activity over time. And both can be used to accelerate growth when an economy starts to slow down, to moderate growth, and when an activity, or when an economy rather, starts to overheat. Fiscal policy can be used to redistribute income and wealth. That is such effect of taxation. Tax is being levied to individual taxpayers for the purpose of redistributing that wealth to other people. So the overarching goal of both monetary and fiscal policy is normally the creation of an economic environment where growth is stable and positive and inflation is stable and low. So both policies can actually be used to control inflation, as the credits and money in circulation in the economy affects inflation, as well as spending, not just private spending, but also government spending. Crucially, the aim is therefore to steer the underlying economy so that it does not experience economic booms that may be followed by extended periods of low or negative growth and high levels of unemployment. So it's to make sure that the roads are not bumpy for the economy. That is why monetary and fiscal policies exist. All right? So I hope that is clear. So with regards to the discussion on monetary policy, we have the central bank that calls the shots when it comes to the implementation of monetary policies. So in the Philippines, we have Bangko Sentral ng Pilipinas. Specifically, the role of a central bank is that it's an institution that manages the currency and monetary policy of a state or a country. So, yes, they are the office or the financial institution responsible for printing our money or taking that money away from the banks and keeping it in their coffers to control the interest rates and the economic activity. So they are also the financial institution that, aside from printing money, ensures banking stability. So they don't just print and issue money, they are the regulating agency for banks, and such that they also oversee the commercial banking system. So if you would check with your banks, everything is in accordance with the policies and procedures set by the Bangko Sentral ng Pilipinas. Lastly, aside from being a regulatory agency or the bank of banks, they can actually act as lender of last resort to the governments and commercial banks. So yes, Bangko Sentral actually performs some banking functions. They can actually lend money to the government and commercial banks, but take note, they are the lender of last resort. So they are not the agency that you should first go to when you are in need of money and you are in a bind. Usually, you go to the BSP as a last resort. All right. So now that we have an idea of what the role of a central bank is, let's revisit monetary policy. So, monetary policy is the policy adopted by central banks or monetary institutions to influence the nation's economy by changing its money supply to achieve the desired impact on GDP, employment, and price levels through doing the following three things. So what are these three things? It's changing the reserve ratios, open market operations, meaning the buying and selling of securities, and actually changing the discount rates. So we will go through these activities one by one in the next few slides. But before we go there, let's first understand the fundamental concepts of why we need money. So, why do we actually need money? Money is something that we need on a day-to-day basis. And actually, there is the two types of demand for money. First is the transactional demand for money. So when we say transactional demand for money, this is the demand for money for use in the day-to-day living, such as the buying and selling of goods and services. So in terms of transaction demand, regardless of the interest rate that is prevailing in the market, it doesn't need or it doesn't change our personal need to have money in order to gain access to goods and services. So, for short, transaction demand for money hits the need for us consumers to have money in order to be able to live. So, for that purpose alone, we need money regardless of the prevailing rate of interest. So, as you can see from the graph on your left, the transactional demand for money is not affected by the interest rate because of what I have just discussed a little bit earlier. So the second type of demand for money is the asset demand for money, or the demand for money as a store for value. So as we know, money has its inherent value. So our 1,000 pesos is valued at, of course, 1K without considering inflation. So when we're talking about money as a store of value, meaning the ability of money and its purchasing power into the future and the current function of money that could be retrieved or exchanged at a later time. So as you can see here, this is a very familiar graph. So we just discussed determinants of interest rates. And in that particular lesson, we have proven that there is an inverse relationship between the demand for money and the nominal interest rate prevailing. So if the nominal interest rate that prevails is high, expect that the demand for money is low because you don't want to borrow money at such a high rate and use it for something. Use that money to transact. But if you take a look at this graph, if interest rate is low, for sure, there will be an increase in the demand for money because there is a lower cost to borrowing that amount of money. So you're gonna be enticed to spend a lot more when your interest rate is very low. So why are we talking about the demand for money and its relationship with interest rates? This is for us to be able to understand why the central bank has to intervene through monetary policy. So if we combine the two graphs individually, meaning we combine the graph for the transactional demand for money and the graph for the asset demand for money, we come up with this. So this is the combined graph for the demand for money in terms of transactional demand and asset demand. So as you can see here, it's slightly different from asset demand for money because this graph has a steep slope, whereas this combined graph is, or this combined graph is curved. So it nonetheless reinforces our theory that interest rates are high and money demand is low. That's a no-brainer. And on the other hand, if interest rate is low, of course, the demand for money will be high because, again, the cost of borrowing money is attractive. So you are therefore able to borrow more money and spend it more and pay less interest. So now that we understand this, let's go into it from the perspective of the central bank. So just like any other businesses, banks and the central bank has financial statements. And if we take a look at the financial statements of a central bank, we will see the following. So its assets, liabilities, and capital, just like everyone else's. But as you can see, a central bank has foreign assets, domestic assets, claims on government and public enterprises, claims from the private sector, claims on domestic money banks, and other financial sector entities. So aside from holding on to local and foreign assets, they actually have receivables from different sectors. On the other hand, they will have liabilities as well, which come in the form of reserve money, meaning the money that is being kept in the vaults of the commercial banks that they keep in the office. Currency in circulation, meaning the money that is currently revolving around the community. Reserves of commercial bank. So what are these? So these are the money that are deposited with commercial banks that is being remitted to the central bank for safekeeping. So this is aside from the reserve money that they keep. The reserve money that they keep is the amount of cash that they will be shelling out later if they see that the economy actually needs it. Just like any other entities, it has foreign liabilities, other deposits of commercial banks, central bank securities, deposits from the government, and equity capital. So later, we will understand why are all of these deposits under the liability section of a bank's balance sheet or the central bank's balance sheet. So we are studying the central bank's balance sheet in order for us to understand how these monetary policies affect the composition of the central banks and the commercial banks' balance sheet. So let's go to the different methods that the central bank employs to control the economy and the interest. So one of the ways in which they control the rates in the economy is through the required reserve ratio. So what's the required reserve ratio? So the required reserve ratio is the percentage of deposit that is to be kept by commercial banks as mandated by the central bank. It can be decreased or increased depending on what type of monetary policy the central bank would like to enact. So here is an example of how the required reserve ratio actually works. So here, so Bank A and Bank B, both are commercial banks, and both, as you can see, have their individual T accounts. So here, for Bank A, let us say I am actually depositing 1 million pesos. And based on the current required reserve ratio as imposed by the Bangko Sentral ng Pilipinas, they're supposed to keep 20% of all deposits in their vault. So what does that mean? So out of the 1 million rather that I deposit, they are required to keep 200,000 and use the 800,000 in other ways. It could be they engage in a loan activity, they use my money and lend it to someone else at an interest rate, or they invest it in something else. Now, to answer our question from earlier, why are our deposits a liability in the bank's balance sheet? It is simply because we, as depositors, indirectly, through our act of depositing the money, are telling the bank that, hey, I have excess cash. You can use it and give me a decent rate of return. So basically, the bank, by accepting our money, accepts that liability. It is through their activities in terms of loans that they are able to make more money and share that return with us by giving the depositors an annual interest rate share. And that is the published interest rate that we see when we open our savings or checking account. So for short, the banks make money, not with their own cash, but through the cash deposited by its depositor. And so, from Bank A, the 1 million pesos that I deposited ends up being lent to another person for 800,000 pesos. So why only 800,000? Because the central bank requires my bank to keep a reserve of 200,000 pesos. So for short, 200,000 of my 1 million actually ends up in the bank's vault. And this other person who loaned 800,000 from Bank A has a separate bank account, and it is with Bank B. So the money that this person got from Bank A was deposited in Bank B. And just like Bank A, Bank B has to comply with the required reserve ratio set by the Bangko Sentral. So out of the 800,000, Bank B has to save 160,000 pesos and can actually lend out to a third person 640,000 pesos. So that third person can actually do the same thing, can actually spend the amount that he borrowed or deposit it, and then that particular bank would have to keep the required 20%. So, by engaging in this transaction, the 1 million deposit has increased the money in circulation by 5 million. So how did I get to that number? We have a deposit of 1 million, and then there is a required reserve of 20%, meaning this deposit of 1 million is 20% of the whole amount that is supposed to be in circulation in the economy. So at the current rate, if 1 million is required to be kept in reserve, how much is the total money in the economy? So that's 1 million divided by 20%. So therefore, you increase the money that is rolling around in the economy by 5 million by engaging in such deposit. So here we see that the central bank actually mandates the required reserve. Now, what does this mean for us? If the central bank drops the required reserve ratio, it means that it is fueling the economy to spend more money because it is adding to the cash that is already in circulation. On the other hand, if the central bank increases or adds the required rate, the required reserved ratio rather, and increases it to 30%, it is therefore limiting now our ability to spend because it is taking away money from circulation. All right, and in the next few slides, you will be able to see this example. So this is how the central bank controls the amount that people can spend in the economy through playing with the required reserve ratio it imposes in the banks. So hypothetically, it's this. If the bank requires that more money be kept in the vaults, therefore, there's less money for depositors and individuals to spend. If the Banco Central lowers the percentage of money that is required to be kept and set aside in its vaults, it's actually encouraging people to spend more. So that is the gist of the required reserve ratio. All right. Now let's move on to the second tool. The second tool is open market operations. So in an open market operation, the central banks will either sell or purchase securities directly from the Bureau of Treasury. And in engaging open market operations is vital because they determine the change in the excess reserves of the financial institutions and directly impact the money supply or the interest rate. So, in the required reserve ratio, the central bank is trying to control the spending of the individuals. So, in open market operations, they actually try to do that by actually flooding or taking away from the economy some of the securities that are being sold by the Bureau of Treasury. It's either they purchase it directly from the Bureau of Treasury or they purchase it from another bank. So here is an illustration. So here, the central bank bought the treasury securities. So the treasury securities bought were 1 million. And the prevailing required reserve ratio is 40%. So when the BSP actually buys the 1 million treasury shares from Bank ABC, it actually increases the treasury securities. So therefore, it increases the assets. And for the side of Bank ABC, once the BSP takes the money out or takes the securities out, it actually decreases the assets. But in exchange, that payment to Bank ABC actually goes to the BSP because that same money will be remitted to the BSP. And it will actually also increase the reserves of the commercial bank, and therefore the BSP's liability to Bank ABC actually also increases. So what is the impact of this particular transaction? So as you can see here, the required rate of return is, or the required reserve ratio rather, is 40%. So if the 1 million that is in reserve currently represents 40% of the entire amount that is supposed to be in circulation, how much is that amount? So 1 million divided by 40% is 2.5 million pesos. So as you can see here, the increase in the RRR is a move to curb the spending of consumers because the central banks would like to control inflation. Kaya po natin tinataas si required reserve ratio because we want to curb or we want to decrease the spending of consumers because we don't want prices to go up too much and be inflated. All right. So for recap, we see here the ledger of the BSP and the bank. So from the bank's perspective, it has decreased its treasury securities because they actually sold it to the central bank and gained excess reserves from the proceeds of the said sale. The proceeds of the said sale will then be used in lending more money to its individual depositors and increase consumption. But from the point of view of the central bank, the increase in treasury shares is because of the treasury securities that has been acquired by the BSP. And there is an increase in the reserves of the bank, which became their liability, who sold the security to the Bangko Central. All right, so here is an example. Here is a demonstration of what we mean by controlling the economic activity or the consumer spending by changing the required reserve ratio. So here in the previous example, we have a required reserve ratio of 20%. But then when it came to open market operations, the required reserve ratio has now gone up to 40%. And as you can see, increasing the required reserve ratio to 200% resulted in cutting the money in circulation in half. All right. So I hope this is clear. This is the result of changing the RRR and its impact on economic activity. So to summarize, there is an inverse relationship between the required reserve ratio and the money in circulation. So if there is lower required reserve ratio requirement, therefore, there is more money in circulation. But if the required reserve ratio is higher, there is less money in circulation. All right. So I hope that is clear. But we're not done yet with open market operations because we have just talked about the central bank buying from a commercial bank or buying from the Bureau of Treasury. What about if the central bank is the one selling the treasury securities? So when it comes to selling treasury securities, here is what's going to happen. So once the Bangko Central actually lets go of the treasury securities, its asset actually decreases because it let go of the money, or it let go of the treasury securities that it used to have. From the perspective of the bank, the treasury security increases because they got it from the central bank. And in exchange, the reserves that they could have lent to other people actually decreases because they had to pay the central bank that amount. And in this regard, by paying the central bank the 1 million pesos, they're actually decreasing also the central bank's liability to them. So, by selling treasury securities, the central bank is limiting our power to spend. So, here, we can see that by asking Bank ABC to buy these treasury securities from them, they had taken away the opportunity from Bank ABC to lend 1 million to an individual that is in need of cash. So therefore, this move actually decreased the cash in circulation by 2.5 million pesos. All right. So again, this is in line with our earlier summary that if the required reserve ratio is increased, it limits the amount of cash in circulation. If it is decreased, it increases the available cash in circulation. All right. So I hope that is clear. So that is open market operations as engaged by the central bank and a reinforcement of the RRR or the required return ratio. What is the third method of the central bank in controlling the economy and interest rates? The third tactic that is being employed by the central bank is that they actually change the discount rates. So the discount rates are the rates on loans made by BSP to the commercial banks. And there is actually an inverse relationship between the discount rate and the amount being borrowed. So let's not confuse ourselves with discount rates and interest rates because those two are actually different from this particular perspective. In terms of monetary policy, discount rates and interest rates are different. So the discount rate is the interest rate that the BSP charges to depository institutions and to commercial banks on its overnight loans. So if you would remember at the beginning of our video, we said that the central bank can actually lend money to commercial banks and other depository institutions. And when they do lend money, it is usually on an overnight basis. So if you hear the term discount rate in that context, you are talking about the interest rate charged by the Bangko Sentral to the lending bank for borrowing their money overnight. Okay? So the discount rates are set by the BSP and is not determined by the market interest rate. So the discount rate in this case is internally set and is not affected by any market activity. So on the other hand, your interest rate is the amount charged by the lender to a borrower for use of an asset. So we have repeatedly established that interest is the cost of borrowing money. So that's the cost you pay if you're borrowing money to or from a third person. So interest rates are mostly calculated on an annual basis, which is also known as the APR, as was previously discussed in determinants of interest rates. And in terms of which assets can be borrowed and can be charged with interest rates, we're talking about cash, fixed assets, or other equipment. So borrowing these assets can actually get a person or have a person pay an amount in interest. So those are two different things. So when we're speaking of overnight loans, we are talking about these very, very short-term borrowings that happen between the central bank and a depository bank, because this also implies that money has to be returned the next day. And with this short-term borrowing, it is part of our discussion in money markets, which is in the next chapter. So after discussing all of those things, we now get to summarize. So there's actually two types of monetary policies utilized by the Bangko Sentral ng Pilipinas and other central banks. One is expansionary monetary policy. So it is used when the central bank wants to stimulate the economy by lowering discount rates. So therefore, when you want to expand, you want to encourage people from spending. So you encourage spending by lowering the discount rates and encouraging the banks to borrow more money from the central bank. And you also increase the money in circulation through buying and selling these treasury securities, and also decreasing your reserve ratios so that the amount of cash in the economy actually is added to. So this is the monetary policy that is employed during a recession. So in the US, this is how they actually did it. They actually were trying to stimulate the economy by handing out stimulus checks and encouraging people to spend at the beginning of the pandemic because they wanted to prevent a recession. So this was why stimulus checks were given in multiple rounds. So they called it EIP program, or the Economic Incentive Program. So they're trying to incentivize people to actually spend, because if people does not spend in the pandemic, the economy will die. Why is that? Because during the pandemic, everything shut down. Businesses closed, schools closed, offices moved from working to an actual office building to their individual homes, meaning they get to save on gas, they get to save on allowance, and they get to save on rent for these offices. And this decrease of spending has actually impacted the economy because everybody was doing it. Everyone was equally impacted. So to prevent this from happening, the American government crafted the American Rescue Act and actually resorted to ask people to spend money by giving them dole outs. So this was the tactic to prevent the American economy from dying. And this was also one of the reasons why our government was really adamant to try opening up the economy after a few months of shutdown, because they knew that our economy couldn't handle a prolonged recession. So that is why they were trying to do business as usual, because they didn't want the Philippine economy to dive further down in recession. So on the other hand, if there is a monetary policy that revolves around the expansion of the economy, of course, there is a policy that is meant to contract the economy. So this is where contractionary monetary policy comes into play. So contractionary monetary policy is used when the central bank wants to slow down the economy by increasing discount rates, decreasing the money in circulation, and increasing reserve ratios. And this tactic is actually being employed to lessen inflation. So if the opposite happens, therefore, we have a problem. If there's too much spending going on, we create a huge pool of money in circulation and we drive the prices of basic goods and other commodities up because there's so much money to spend and you're able to afford it. And so to prevent that from happening, the central bank has to tighten our belts for us. That's why I'm using a belt visual for this, so that it can actually curb or slow down the effects of inflation. So we might not see this directly, but definitely they are doing something within the financial institutions. All right, so that's expansionary and monetary policy for you. But to end our lesson for today, let's not forget to tackle the issues in monetary policy. First, monetary policy is fast and flexible because it does not lie with the executive branch. It lies within the central bank. So there is no political pressure. So there's no political pressure. It's fast, it's flexible. So it means that it's immediately actionable. However, there is a delay in terms of recognition and operation rather, or when you talk about it, there is a delay in terms of recognizing the problem and its efficacy because monetary policies are preventive rather than proactive. So what does this mean? Monetary policy is around to prevent a situation from getting worse. It's not there to actually prevent the situation from happening before it actually happens. So monetary policy only works if the situation is already present. It's a way to control the damage that will be done by the situation at hand. And of course, there is this thing called cyclical asymmetry, which means that there is an imbalance between the policy one is trying to implement and the effect is contradictory. Now, what does this mean? So, when we talk about cyclical asymmetry, we see that one method is effective, but the other way, not so much. So when the central bank, for example, would try to contract the economy, it is felt immediately because once the central bank increases the required reserve ratio, increases interest rates, and increases discount rates, the bank immediately will act upon it. They will also increase the interest rates on loans and increase their annual interest rates. So, to that effect, people will be encouraged to save up. But if the opposite happens and the central bank is in the middle of a situation where the whole country is in recession, it's more difficult to start up an economy from a recession, which was seen and felt all over the world during the pandemic. And when we try to stimulate the economy, we're not even sure that it would work. However, if we contract the economy, immediately the effect is actually felt. All right. So these are just the common issues of monetary policy. So before we close our lesson, here are some additional references that you could use in learning more about this topic. So I hope this helps, and I hope you learned something new from us today. I'll see you in the next one. Bye.